To share with this is the meat and potatoes. Now, we'd like to thank Jan Skokels for providing the research and this paper here, but I'd like to share this with you. In a move that could reshape the global community's landscape, the Shanghai Futures Exchange has announced sweeping reforms that will allow direct participation from overseas investors in China's domestic gold and futures markets. For the first time, foreign brokers could trade on the exchange without the need for an onshore intermediary. Margin requirements would be accepted in foreign currencies, and physical delivery would be a core feature of these contracts. This isn't just a bureaucratic update. It's as one person put it, a constitutional change. Beijing is making clear bid to shift global pricing power eastward, reflecting its dominant position in the physical metals production and consumption. If the reforms pass and Shanghai becomes a center of physically settled metals trading, it will mark the beginning of the end for paper gold markets controlled by Western institutions. For decades, reference prices have been dictated in London and New York. Now China wants real gold, not leveraged contracts to set the standard, and this is just one piece of a far larger puzzle. If China truly wanted to undermine the U.S. dollar's dominance, how would it go about it? Well, it wouldn't be announced as tensions with fireworks. There would be no dramatic dumping of treasuries, no flashing currency announcement, or overt declarations of war on the dollar. That's not how Beijing operates. Instead, the move would be slow, deliberate, and strategic. It would unfold quietly behind closed doors in policy documents, trade settlements, and crucially in vaults filled with gold. What China is doing now is nothing short of a silent re-engineering of the global financial order. And at the heart of this transformation lies a simple but powerfully pairing gold and yuan. The Chinese relationship with the US dollar has always been a double-edged sword. For years, Beijing amassed a vast portfolio of US treasuries, peaking at over $1.3 trillion. This was a byproduct of its trade surplus and the structure of global finance. But in recent years, China has started trimming its exposure, reducing its holdings to around $759 billion. On the surface, this appears to be standard portfolio rebalancing, but in reality, it's part of a much larger strategy. Holding too many dollar-denominated assets leaves China vulnerable to the whims of Washington. The risk is not merely theoretical. China has watched the U.S. use the dollar-based system to impose sanctions, freeze assets, and apply pressure on geopolitical rivals. And with each incident, the message becomes clearer. The dollar can and will be used as a weapon, and so China is acting accordingly. Rather than risk exposure to unpredictable political environment, Beijing is shifting its reserves towards assets that are, by their very nature, politically neutral. Chief among those is gold. Officially, China holds just over 2,290 tons, making up around 6.5% of its official reserves. But many analysts believe the true figure is far higher, and some suggest that the People's Bank of China may be buying gold at multiples of the rate it discloses, bringing its real holdings closer to 25,000 tons or more, not to mention how much the public privately own. Now, gold offers Beijing more than just simply security. It offers sovereignty. It cannot be sanctioned, frozen, or devalued by central banks. It is, in essence, the opposite of the dollar. And this is where strategy gets even more interesting because it's not just about stockpiling gold and reducing exposure to U.S. debt. It's also about building an alternative financial system, one that is capable of functioning independently from the dollar and, over time, replacing it altogether. Part of this effort involves a gradual internalization of the yuan. And now, historically, the Chinese currency has been constrained by strict capital controls and a lack of global trust. But rather than liberalize yuan too quickly, which could invite instability, China is taking a slower, more calculated path. It's tying its yuan to gold. Through initiatives like the Shanghai Gold Exchange and the Shanghai Futures Exchange, China is offering a market where gold is not just a speculative asset, but a key part of the financial system. And crucially, it's creating mechanisms for physical settlement, not just paper speculation. China's proposed reforms to the Shanghai Futures Exchange would open its gold futures market to foreign participants. But unlike the paper-based trading of the COMEX, or that we see on the LBMA, the London Bullion and Marketing Association, these contracts are tied to physical delivery. If approved, this change would be a profound shift in the way gold is priced and traded. It would mean that actual possession of gold, not just leveraged bets on the future price, would start to determine market value. Now, I know we're talking about gold, but The article is written that way, but this is actually about silver. Silver is much more rare than gold right now in terms of availability above ground stocks. Now that this might sound like a minor procedural change, but in reality, it's a direct challenge to the Western dominated pricing system that has since existed since the 19th century. If Shanghai becomes a global hub for gold settlement, then China sets the price. And once physical demand starts dictating the price of gold and silver, not the ETF flows or speculative futures trade, then the power dynamic in global finance begins to tilt. There is something elegant about China's approach. It doesn't seek to trigger a crisis or escalate tensions. Beijing has no desire to blow up the system, instead, is quietly opting out of it, building a parallel framework that functions on different principles. Remember, we talked about the Chinese Interbank Payment System, CIPS? Gold plays a crucial symbolic role in this effort, unlike fiat currencies, which rely on faith in government and central bank policy. Gold is grounded in something more enduring. It carries no counterparty risk. The value is recognized across cultures and centuries. For countries wary of the dollar's dominance, this matters especially when that dominance is increasingly viewed not as a service, but as a form of control. And this is where China's strategy starts to find willing participants. Countries like Russia, Iran, Venezuela, and others who have found themselves at the sharp end of the Western financial system are increasingly turning to yuan based trade and in gold settlement, not because they trust Beijing unconditionally, but because they are desperate for alternatives. Even among non sanctioned nations, there is a growing discomfort with the fragility of the current system. The United States is running record deficits, its debt is ballooning, its financial institutions are buckling under the weight of low yield assets and bought during the pandemic. Bank of America, for example, holds over $700 billion in bonds purchased when the yields were 1%. Those bonds are now down around 40% because as the interest rates go up, the value of the bonds go down. So if you're going to invest in a bond, you could buy mine paying 1% and go out and get a new one paying 4%. I still want to sell mine, but I'll sell it at a discount. Okay. So that's what the secondary bond market is all about. In the meantime, the Treasury is trying to refinance $9 trillion and raise another additional $2.5 trillion of new debt this year. Who's going to buy it? But with foreign buyers increasingly reluctant to step in, the only solution may be for the Fed to restart large scale bond buying. That's like a snake eating its own tail. And that, of course, would further undermine confidence in the dollar and send inflation expectations surging. If yields rise to 7 or 10%, the yields are going to rise to 7 or 10% because people will be turning in their bonds early before the redemption time. And so they're going to be buying $1,000 for maybe $50,000 or $5,000, $500 or whatever. So if you have $100,000 bond, and let's suppose the person originally bought it for $50,000, held it for 9 years, going to get the money back in one more year, sell it to you for $50,000 because they want the cash out of it. Their return is 100%. Now you see we're getting close to this 10% when you average and meld it all together. Frozen ATMs, bank runs, and a public waking up to the risks of a fractional reserve system. And what is a fractional reserve system? Is that under Keynesian economics or is that under Austrian monetary economics? You guys tell me in the column off to the side. The fractional reserve system was always one crisis away from a collapse. In that context, gold starts to look less like a luxury and more like a lifeline. There's frequent speculation that China may launch a gold-backed digital yuan. In truth, a fully gold-backed currency is unlikely in near term. The demands of modern trade volumes make it difficult to anchor currency entirely to a physical commodity, but that doesn't mean that gold won't play a significant role. That's why we're looking at silver, which is what 1/10 of the cost, actually less than that, of an ounce of gold. So we increase the divisibility, which is why we're buying the dimes, okay? And we also move to the silver because it's coming out of the ground at 7.1, yet it's priced almost 80, 90, 100 to 1. I got on my gold position 120. I netted 107 in sealed type 1 monster boxes. That was a pretty good deal, I think. The demands of modern trade volumes make it difficult to anchor currency entirely to a physical commodity, but that doesn't mean that gold won't play a significant role. A partially gold-backed or gold-supported yuan could offer something far more potent: credibility. In an age of fear, excess, and monetary manipulation, even a modest link to gold signals discipline, prudence, and a long-term vision that might be enough. It's certainly enough for many countries in the global south. As central bank digital currencies develop and alternative clearing systems emerge, the yuan, supported by real assets and underpinned by growing physical gold infrastructure, becomes an increasingly attractive option. China does not need to convince the whole world to switch overnight. It just needs a critical mass of countries and institutions willing to hedge, and that hedge becomes more mainstream. The old order starts to crack. What if China is building not just a revolution, it's a reset? By accumulating gold and gradually elevating yuan in global trade, Beijing is creating a form of monetary leverage that doesn't provoke confrontation, but still weakens the dollar's monopoly. So it's not doing for the show. It's doing for the current system is unsustainable. Gold in this strategy is more than just a store of value. It's a tool of diplomacy, a stabilizer, a silent vote of no confidence in Western monetary policy. And when paired with currency like yuan, controlled, state backed, and increasingly trusted, it becomes part of a new architecture, one that seeks resilience rather than dominance. Now, the dollar won't disappear tomorrow, but its role is being requested in many ways that were unthinkable just a decade ago. And at the center of the shift is China, not just participating in the global financial system, but quietly rewriting the rules. And if you want to get ready for the new financial system, then why don't you head for the exits? Turn whatever digit you have into the coin of the realm. It's that simple. So, number of things are happening. Let me read you some of the changes that have happened as far as the Shanghai Gold Futures are concerned. Extended settlement times. The LBMA, which is a sort of a competitor, they only price metals in terms of dollars and cents, and they roll over in terms of contracts. So if you have 100 contracts and you want your contracts, they will offer you 120. So basically, they don't want you cashing out of the silver. The LBMA, or major center for gold and silver trading, experienced considerable increase in settlement times for physical silver delivery, going from a typical trade plus 1 day to trade plus 8 weeks. 8 weeks, huh? Do they have the silver? That's why we were talking about backwardation a couple times ago. So, logistical constraints. While LBMA officials, as London Boyd and Marketing Association officials, attribute these delays to logistical challenges like a shortage of trucks and manpower, some analysts suspect deeper issues relating to potential over-leveraging and rehypothecation of gold and silver reserves. Depleted inventory, LBMA silver stocks have reached a multi-year low, raising concerns about the availability of physical silver. I'm going to switch back over here to the Vibe board and show you what's going on as far as the U.S. debt clock is concerned, and show you what we're talking about. See, with the two current pricing mechanisms only using LBMA and the COMEX, they have jacked up the number of paper ounces to 365. So if you take 365.42 and you multiply that times the current spot price of silver, which at the time that I did it was $34.60, times 365.43, you know what? You're at $12,643.87 per ounce. Now we say 14 dimes equals 1 ounce. So each dime could be worth around $1,000. And I think this is just going to get the party started. What do you think? So folks, this is what we're fighting against. We got to get rid of this, their ability to create paper when in fact it actually should be metal. Now the argument is, well, the futures market is very easy. It's very necessary. Well, I think the futures market is necessary when it comes to pricing things that aren't there. Like, for instance, if you're going to plant seed in the ground and harvest corn, the corn isn't there. Yeah, you're going to have to, I can see a need for a futures contract there, but not when it comes to mining. This is gold and the silver is already down there. You just got to get it up. Why do you need a futures contract to do that? No, what you do instead is you float bonds. That's the way it should be done. So getting back to this, depleted inventory, the LBMA silver stocks have reached a multi-year low, raising concerns about the availability of physical silver. Geez, I wonder why. They sold it 365 times. Rising demand and potential short squeeze. The U.S. has become a net importer of gold and silver, indicating significant accumulation by powerful entities, and large physical deliveries are being demanded on exchanges like the COMEX. This, combined with low LBMA inventory and high short positions, creates a potential for a short squeeze where the scarcity of physical metal could lead to rapid price increases. It's going to happen like a flash, folks. You either got it or you don't. Growing distrust in paper markets, investors are increasingly seeking gold and silver as safe havens due to concern about inflation and financial instability. And there's a growing distrust of paper-based ETFs, exchange-traded funds, that don't allow for physical delivery. Like SLV. In essence, the delays in physical silver delivery from the LBMA are indicative of a strained market. With strong demand for physical metal, limited supply, and potential underlying systemic risk linked to fractional reserve banking models, all part of Keynesian economics. So, folks, again, if you don't hold it, you don't own it. At this point in time, dimes is still the best deal. They offer the maximum fungibility, the maximum divisibility. More importantly, though, when the silver takes off, do you think there's going to be scoundrels out there that try to counterfeit a good piece of silver? What's going to be easier, a 10-ounce bar or a 1/14 ounce dime that's been around since 1916? We know